This conference will now be recorded.
Hi, and a very good afternoon to everyone. I hope I'm audible enough. Good afternoon. I'm your faculty for the first few sessions. My name is Abhijit Paul. Before we start with today's session, I would request you to please put in a why, yes, something on the chat box so that I know that you can hear me clearly and also you're able to see my screen. Pavan, Sarup, Harish, Ketki, Bitesh, Anil. All right, perfect. Good afternoon. Hello. Thank you for joining in on time. I appreciate that. So it seems like we don't have any technological issues today afternoon. All good. So we're all set to start the 41st batch. Wow. Of the Art and Science of Trading. Great. I have managed to go through your introductions, which you've shared um, in your WhatsApp group. Impressive, passionate, eager to learn. That's the spirit. So, few things I would like to, and I think I should share with you few basic guidelines, rules that we will follow in these online sessions, so that there is no ambiguity later on. All the classes are online, Saturdays and Sundays, 1:30 to 4. At times it can stretch a little bit towards 4:10, 4:15, depends on the flow. I will try my best to be as much as possible to be punctual and not waste your time. I would request the same from you as well. During the session, I generally take around 10 to 12 minutes of a break in the afternoon. This again depends on the flow. Generally, it is around 2:45, between 2:45 and 3. We'll take a 12-13 minute break because 2.5 hours at a stretch online session is difficult for the trainer, as well as much more difficult for you who's listening and trying to pay attention. So we'll take the break every session. I will be predominantly speaking in English. All that I will write and make scribbles here in this notepad, as you can see here, will be in English. I will not be using any PPTs, no slides. I will only be using charts, few Excel sheets, few websites, and these scribbles, these notes that I'm going to make here in front of you. You need not write anything down. You did not make any notes, take any notes. I will share these notes in PDF format on your WhatsApp group at the end of every class. So all that I request is to pay attention and be as interactive as much as possible, right? Now, all these sessions are recorded and they're shared with you. All these are taken care by our course coordinators. Very efficient they are. So anything pertaining to the course, the recordings, what time is the class, or any issues you're facing, you can connect with the course coordinator. Any issues or questions you have pertaining to the subject, you want to know what is a moving average or what is a trend line and support resistance, please do not ask the course coordinator. She'll not be able to help you. Ask me, okay? There's a WhatsApp group. You can ask me, you can put @ so that I know that it is directed towards me, or else in the entire flow of messages, we all tend to get lost. While taking these sessions, when I have to address you, you have to allow me, you have to give me permission to address you with your first name. So if you ask me any question, let's say if Akhilesh asks me any question, then I'll say, I'll take his name, his first name. This is very important for me because once it such happened in one of the batches of this program, long time back, I think 2-3 years back, it happened that someone had asked a question and it was an interactive session, just like this, a Saturday or a Sunday afternoon. And I happened to address him with his first name and answered his question. And to my surprise, I received an email from that person later in the evening saying that, how dare you take my first name? Do you know who I am? I said, no, sir, I don't know who you are. Not as closely as I would have liked to. But then he wrote in that email in a very descriptive manner that he's a very senior person and he's worked here and there and everywhere. And of course, he has set very high regards for himself, which is temporary and which is good. But then I'm not aware of it. So I'm 41 years old. You can be in the yardstick of the age. You can be higher or lower. Doesn't make much difference to me. But you have to allow me, when I address you, I'll take your first name. Okay. If anyone has an issue, you can privately let me know. Then I will look into it separately. All right. So let's start and let's slowly scale up. Day one, today, I will be primarily discussing trading, typical human behavior, expectations, and what is this trading all about. We need to be in the same plane of understanding, or else chapter after chapter, if I just open the PDF and I just go one after the other explaining concepts to you, it's not going to make any difference, or else anyone could have attended a trading program on trading and would have become a trader. It doesn't work that way. Time and again, I have met hundreds of people who have attended not only one, but 3, 4, 6, 7 different programs from 7-8 different people from 7-8 different countries, but still it didn't work. It doesn't work that way until and unless we all understand the core. So the first hour today will be focusing on the core. You can consider the first hour today as when you look at the farmland, when you look at the farmers, before they start anything on the ground, on the field, they are going to get the field ready. They're going to scrape off the field. They're going to prepare the earth so that it's fertile enough to grow healthy crops, right? So you can consider the first 60 minutes of today's session as that. Now, before I go in, you can know a little bit more about me. You can visit any of my two websites. I have one on my personal name, which is abhijitpaul.com, and I also happen to be a trainer for mentorship traders. So either of the two websites you can visit and you can get to know more about me. Now, before we start, the first step that we should take, the very first step that we're going to take is look at this Excel sheet, right? If you focus on this Excel sheet, you will notice that I have few columns and rows. Date, which is essentially time, and then it is followed by open, high, low, close, OHLC, which are the 4 parts of price in any one particular day's trade. The opening price of the day, the price at which the market opens, the closing price of the day at which the market closes, the highest point of the day and the lowest point of the day. These are the 4 price points that the stock market or the exchange offers us. This is price. And then we have a volume. Volume is the number of shares exchanged hands. I buy 100 Reliance Industries, you sell those 100 Reliance Industries to me. 100 plus 100, 200 is not the volumes. 100 is the volumes, the number of shares exchanged hands. This is the mother information. This is the raw, key, most important information that we get from the market. Price is God, or let's say there's a saying, Bhav Bhagavan, which is the price is ultimate, which is a fact, which is derived by demand and supply and etc. We'll get into that later. But we are going to pay the most importance, the core, you can say the my baap, to price. And even within these 4 price points, the most important is the close. Because where you close end of the day matters the most. Where you reach towards the high point, did you able to hold on to it or low, and where did you open because of some international news, etc. All these things are fine. But the most important thing is end of the day, where did you close? So closing price amongst these 4 points is the most important. Now, what is this Excel sheet? This Excel sheet is nothing but a recording of data. What have I done? I have gone to the exchange, and all the exchanges worldwide does provide this data either freely or they charge. Whatever be the reason, whatever be the case, I have recorded past historical data of price and volumes. And in this case, I have taken the 1st of Jan 2002, and the price data is that of the Nifty 50 index. Open, high, low, close of Nifty from 1st Jan 2002, and I have data till around 2015. Okay. Now I can easily take one column, which is time, and I can take another most important column, which is close, that is price close. And these 2 parameters, I can easily transform, shift this tabular information, the information of price and volumes, which was in the form of a table, to the form of a chart. This is a two-dimensional representation of the same table. On one axis, on over here, you have time, and on the vertical axis, you have price. And then you can clearly see from 2002 how it consolidated, how it picked up, how it topped out in the end of 2007, the severe bear market of 2008, and then it slowly managed to bounce back and reach all the way back to its high early 2011, and so on and so forth. This is a visual representation of the tabular information. The table has now taken the shape of a chart. It's a 2D chart. It's a two-dimensional chart. Now, you probably were not there in the stock market in 2002, 3, 4, 5, 6, or 7. That depends. But then even if you were not there, by looking at this graph, by looking at this chart, will you not have a sense of what had happened? Will you not have a sense of how did price evolve over a period of days and months and years? Of course, yes, this is visual representation. By visually looking at it, you get some understanding, you get some feel of it, right? So the core of a technical analysis or a technical analyst, or the core of the subject of technical analysis, is this two-dimensional chart, wherein you look at the historical price behavior. Very important word, historical. So we're looking at the past. What are we looking at? Price. So current price is right at the edge. Historical price is right towards the left of the chart. And I say price behavior, very important word used here, behavior. Now wait a minute. Price I can understand. Historical price, that I can also understand. That why am I using a word behavior to price? Because behavior is primarily to attach to emotional animals. Like, let's say you and I, we may be emotional animals. We are emotional animals. And so we behave, right? How can we attach behavior or the word behavior to price, which you may say is not an emotional animal at all? It's derived from the buying and selling, right? So before I go into that, or let's talk about that. Let's talk about this behavioral aspect in detail first. So we're talking about a very important term here, which we just used, behavior. Now, behavior, of course, is of animals, you and I. What behavior is there to do with the stock market? Of course, there is. How? Now, the people, those who trade, invest, risk their money to make returns, they have behavioral aspects, you and I, and the hundreds and thousands of traders. Even when we put in our rules of buying and selling into a algorithm or into a computer, even if the computer is doing everything on its own and we are not seated in front of the computer, still the formula, the algorithms, the rules are created by people. And people, we, our own emotional aspects, get reflected in those rules. Now, we will look into this into a little more deeper manner, okay? Before that, let's try and understand that if you have a stock which, let's say, closed at 100 on Friday, let's say, how does this stock go up, let's say on Monday in the afternoon? You find the stock from 100, it has gone to 102. How did it go up? What made it go up? How does stock prices go up? Demand, says Aditya. Okay. Buyers, says Akhilesh. News, says Pawan. Okay, so let's understand these three words: buyers, demand, news, etc. Okay, one by one. So let's take up Aditya. Okay, Aditya, you have to allow me to take your example here. I'll take your name. So let's say Aditya finds this stock attractive. He did some analysis. It can be technical, it can be fundamental analysis. He might have got a nice advice from his advisor. Maybe the MD of the company came in his dreams and told him to buy his shares on Monday. Maybe he looked at the position of the moon and Jupiter. Whatever be the reason, doesn't matter. Whatever be the reason, it doesn't matter. What matters is he has created an anticipation within himself based on whatever be it, that 100 is a good price that I should bet into, I should buy. And I expect this 100 to go up further, up 101, 2, 3, 4, maybe 110. Of course, everyone who's buying for 1 rupee or 10 rupees, everyone who's buying expects the price to go up, or else why will he buy? I hope you agree with me, right? If you knew that 100 will come down to 99.8, will you buy at 100? Of course not. So the moment someone is buying, he or she anticipates prices to go up. That's why he or she is buying. The reason behind the buying is not important. Please understand this. There are all different types of monkeys in the market. So the reason is not important. I'm not going into the reason. I'm going into the action. So the action is anticipation that 100 will go up. So what does Aditya do on Monday morning? So Aditya opens his broking platform and he places an order to buy a certain number of shares at 100. Now wait a minute. He will get these shares at 100 only when someone sells those shares to him at 100. And so he finds that there is no seller at 100. The nearest seller is standing at 100.2. So he's waiting at 100 and the nearest seller is standing at 100.2. This is where the demand is to buy, and this is where the supply is to sell. Now what happens? Nothing happens. Why? There is no match. So what's happening now? The buyer is waiting that please come down and sell it to me at 100 because I'm waiting down at 100 to buy from you. What is the seller thinking? Please come up and take it from me at 100.2. So there is, for few seconds, few fraction of a seconds, or maybe few minutes, there is a test of, let's say we can call this willingness. This willingness can be willingness to buy and also the willingness to sell. The market is testing out Aditya's willingness to buy. The market is also testing out, let's say, Akhilesh's willingness to sell. Let's say Akhilesh is on the other side. Now, both have a certain degree of, now let's understand this. Both of them now have a certain degree of fear within them. They have a little bit of fear within them. What is this fear? The fear that Aditya has is, what if I wait, keep on waiting, and it goes up to 100.5 or 101? I'll keep on waiting at 100 and no seller may come down and buy from me. So what if by waiting, this willingness to buy, and by waiting for 100, I might lose on, it might go up 101, 2, 3, I might lose out. Akhilesh, who's trying to sell at 100.2, also has a certain degree of fear. Now he's thinking that what if I, by me waiting to sell at 100.2, what if it falls to 99, 99 and a half and 98, and I'll keep on waiting at 100.2 for sell and it doesn't happen. So both of them have certain degree of fear in them. Now it all depends on the willingness now. Let's say Aditya feels that the 100 will go to 102, 3 or 4 very easily. He feels so, he anticipates so. Again, I'm going to repeat. Why he anticipates so, it doesn't matter. It can be based on his analysis, it can be based on his advisor, it can be based on any damn thing. So he thinks that what the hell, why am I waiting for 10 paisa, 20 paisa? I'm going to match 100.2 and buy it. And so he modifies his order and he buys what the seller was willing to sell at 100.2. Damn, now you got to trade. Now all of a sudden 100 moved to 100.2. How did it move? Because the willingness of the buyer was more than the willingness of the seller. We can easily rephrase this line: willingness of the buyer, demand; willingness of the seller, supply. And so, as rightly Rajat has written, demand greater than supply. The willingness to buy is greater than the willingness to sell. 100 goes to 102, 100.2, 100.2 can go to 100.5, 100.5 can go to 101, 2, 3, 4, 5. Of course, it doesn't go in a straight line. Of course, it doesn't go keep on going up. In this, there is ebb and flow. There is an ebb and flow of up and down like this. But overall drift is on the upside. Every time it drops by 10 paisa or 20 paisa, Aditya keeps on buying. You understand the point? So the overall drift is on the upside, primarily because demand is greater than supply. And exactly the other way around, supply, when it is greater than demand, it leads prices to fall. So we can say, we can conclude from here two important things, very, very important. When demand is greater than supply, this leads to trends of prices going up. We can call it an uptrend. And similarly, we can also say the opposite is when supply is greater than demand. Yeah, we can say that the downtrend. This is important, right? Now, in this entire scenario, was there behavior involved? Of course, there was behavior involved, right? The other behavior, which is quite a predominant behavior, which is generally said, is the word greed. Okay, I would add, now this is not exactly behavior. Fear, greed, these are emotions. These emotions will lead to certain kind of behavior. Okay, fear is not a behavior. Fear is an emotion. Greed is not a behavior. Greed is more of like an emotional aspect, which leads us to behave in a certain manner. Okay, a very important behavior, or I'm sorry, a very important emotion is hope, which plays a very important role. Okay, so greed and fear, of course, is there, but if you allow me, I will say greed, fear, hope. There are a lot of, there's a, let's say, a concoction of a lot of emotion that goes into creating this demand and creating this supply. Okay, and what will lead to the behavior? The behavior was, let's say, Aditya's behavior was what? He did not wait for 100, he matched 102 and he bought. This was a behavior which let the price go up from 100 to 102. Okay, so now you would have understood that when the price goes up, down, even when the price stays stagnant, every day, every hour, every minute, and every second of trading, either it is manual trading or automated trading, behavior is involved directly or indirectly, behavior is involved in each and every trade. All right. If you agree to me that yes, behavior is all right, directly, indirectly, manually, or in an automated manner, of course is there in each and every price point, then an important aspect would be for us to realize that what is the nature of behavior. Because if we, okay, so let me do this. What is the nature of behavior? Because if it is behavior which is there in each and every price point, in each and every movement of the market, then to understand market, then to understand what can happen to the market going forward, it is crucial, it's extremely critical, it's very crucial for us to understand the nature of behavior. And one very important nature of behavior is that it repeats. At times it rhymes. It is extremely repetitive in nature. Your behavior, my behavior, everyone's behavior, they are repetitive in nature. Say, for example, if you want to connect with me in this aspect a little bit more, let's draw a few analogies. Let's say, for example, I am your neighbor, or let's say your elder brother or uncle or whatever. And then I realize I visit your house, I'm talking to your parents, and they say, no, Aditya, Kilesh, Anjali, whatever, everyone. So let's say they say, your parents tell me, no, no, वो तो घर पे पढ़ाई कर रहा है, अपने room में है, he or she is studying. Now, I know you very well, I've seen you from childhood. Can I not say that, oh, इसका मतलब उसका exam आने वाला है? It's 2 o'clock. Thank you, Siri. That's my laptop giving me update of the time. So I can clearly conclude, I can clearly say that surely your exams are coming up or your exams are going on. That's why in the evening you have dedicated yourself to study and not waste and watch let's say Netflix or do something silly. Because time and again, year after year, I've noticed that whenever the exam comes, let's say 2-3 weeks before, you start to get a little serious and you spend an hour or half an hour with your books. When it comes really, really close, let's say a week or 5 days, you spend a little bit more time. And then there are those extremely talented people who will only open the books the previous night and sit for the exam the next day. If you get the picture, then is this not a repetition of your behavior year after year? And if I had observed this year after year, and I find you today sitting with your books, will I not be able to anticipate? Will I not be able to predict with some degree of predictability, with some degree of surety that yes, your exams are coming up, or yes, your exams are going on? Behavior is extremely repetitive in nature. You look at yourself, few of the behaviors are autonomous. You yourself are not aware of it. Classical example would be getting up in the morning and brushing your teeth. I'm making an assumption that you do that. That's a repetitive behavior, but you're not aware of it. It just kind of happens like automatically, right? You're not even conscious of it. But then there are also behaviors which happens consciously. Let's say if there are any smokers amongst us, then you would probably have a certain time of the day, maybe post lunch or post breakfast or whatever be the time, you would love to enjoy your smoke. So that behavior is also repetitive. Those who are short tempered, you'll find that on a drop of a hat, if someone who gets really angry, Tell them something and they'll get angry, they'll fire at you. So behavior is repetitive in nature, and repetition to happen is cyclical in nature. Now, when we are looking at this chart, what are we looking at? I use the word price, historical, and behavior. So now when we're looking at this chart, we're looking at the chart of price, the historical prices, and then from this, we can figure out certain behavioral aspect of price. And when such a behavior repeats again, there is a degree of predictability. I'll take a last analogy, a last simple story, which I'll share with you from my own personal life to seal this topic, and then I'll move on to the next one and take your questions. So, repeats. So, this story is from my own personal experience. I'm going to share this with you. So when I had lived in Mumbai for almost 10 years, from 2004 to almost end of 2013. In my first few months, I used to live in a PG with 4 friends, and I used to share my room with the youngest member in the flat. I was at that point of time, of course, still I am the elder one. So this guy was from Delhi. Right now, I think he lives in Mumbai. So he's from Delhi. He's a young guy. At that point, I think he was what, 20 or 21, and I used to have certain degree of likeness towards him, because he used to think less and act more. So he used to say that, Dada, I am a proud Jat. जो होगा देखा जाएगा, पहले मार देते, पहले कर देते, फिर बाद में सोचेंगे. So he used to talk like that, and I used to really admire him, though he was quite junior to me. Nevertheless, so I had observed few peculiar aspects about his behavior, which I found really, really at times funny and interesting. So this was one of those. So we used to live in Navi Mumbai, close to the hills, towards a place called Kharghar, inside of Kharghar. And in Mumbai, those who are from Maharashtra would know that when it rains, it really, really rains, means it doesn't stop. For at a stretch, 2, 3, 4, or even a week, it can continue to rain. Now, I had noticed a very interesting aspect about this young guy. We were doing our MBA in financial markets at that point of time. And I noticed that when the monsoon was at its peak and it used to rain and the temperature was cooler, and if say the next day there is no sessions, there are no classes, let's say Saturday, Sunday, it's a holiday, there are no classes, right? And it's been raining, then this guy, next day, which is a holiday, will not take a shower. He will take a shower, maybe he'll skip 1 or 2 days. He'll say, no, I'm feeling very cold, I don't feel like, I'm too lazy, I'm gonna sleep, and he'll skip his shower. That's okay, no big deal, as long as you don't stink. But that's his behavior. So there are a few parameters to this behavior of his. One, the average temperature is a little cooler, which is primarily because of the rains in Mumbai. Second, there is no sessions tomorrow or classes for which we don't have to step out, we can stay in our rooms. And when these 3-4 parameters meet, this guy lands up not taking a shower. All right. This I made an observation for, let's say, the first year. Now, second year, when the monsoon comes and it's raining for last 2-3 days, it's pretty cooler, and tomorrow there is no sessions, can I not make a high probability prediction that this guy tomorrow is not going to take his shower? Yes, of course. If I had, let's say, if I had observed 10 times in the previous year, and out of those 10 times, if all the 10 times he had not taken a shower, I've got a predictability of 100% chance. But if he had taken 5 times shower and 5 times not shower, then it's a little difficult. It is as good as tossing a coin, 50-50. But then if he had not taken a shower, let's say 7 times or 8 times, I have a pretty good chance to win tomorrow. I know I have data points of 10 times, out of which 80% of the times he has not taken a shower. And so I think tomorrow he's not going to. So what am I talking about? I'm talking about repetitions of a particular behavior. When certain parameters meet, when you find yourself in a certain environment again, then your actions tend to repeat. If you've been a smoker, you've managed to, let's say, stop or quit your smoking for some time, but then you meet your old school college friends over a drink in some pub or bar, you will end up smoking, because again you meet amongst your friends. Whenever you used to meet amongst your friends, you used to act in a certain manner. Now you meet your friends and you will act in that certain manner. This is repetitions of behavior. And based on these repetitions of behavior, if I make observations, if I keep a note and I find the predictability, if it's 50-50, then it will be very difficult. Then I don't know what he's going to do. Then I don't know, you're meeting your friends today evening, you may or may not smoke because past record says 50-50. But if it is 60-40, 70-30, 80-20, or 90-10, the chance of winning is high. The chance of me going right is very high. And that's exactly what happens in this chart. What happens in this chart is, over a period of time, as prices go up and down and does all its ebb and flow and trends and etc., it leaves behind itself these traits of behavior. These traits of behavior are left behind over a period of time. You and I, when we do technical analysis, when we read the charts, this is our job to pick it up. That exactly what is going on now ideally should lead to a rise or ideally should lead to a fall. And that is what technical analysis or technical trading is all about. It is about the behavior of the market and not, let's say, stocks or shares or company. We are trying to analyze, we're trying to read and understand the behavior of market, or if you want to say in a much more a refined manner, so behavior of money. Money chases money. You need to understand this. So if we understand the nature of money, how does this money flow from one asset class to the other asset class? How does it run to Reliance Industries and not pharmaceutical stocks? And all of a sudden it reverses and it runs to pharmaceutical stocks and comes out of Reliance Industries. And all of a sudden it comes out from gold and goes to equity, and real estate for the 10 years is not doing anything. This is the nature of money, the behavior of the markets, or the behavior of the money, behavior of the traders, investors. This is all that we try to do in technical analysis. We are not looking into the company. We're not looking into gold, in which countries, how many gold is getting mined, all those stuff. Not at all. We're only looking at the word behavior of money or the behavior of the market through via the charts. How can we read this behavior? See, we'll talk about fundamentals and technicals in some time, but when it's fundamental analysis, you can analyze the balance sheet, the profit and loss, you can visit the company plant, you can talk to the management, you can read pages and pages about their products. But then when I say we will understand the behavior of a certain asset class or a company or a stock, where the hell do we look at? Where is it? From where do I start? So the behavior is left in these charts. These price charts are behavioral charts, and what we are going to do is read these behaviors, right? So before I move ahead with, let's say, the difference between technicals and fundamentals, I'll quickly take a look at your questions if you have posted anything. Is it mandatory that the demand is more than supply, the price will go higher? Akhilesh, relatively, yes. Let's say if the demand is more than the supply, then people are willing to buy at a higher price. Now, if it's just a minor higher price, then it may not go significantly higher. But over a period of time, if Aditya is willing to buy at 100.2 and he's also willing to buy at 100.5, then someone else is also willing to buy. Looking at this movement that it went from, let's say, 100 to 105, Aditya maybe has stopped buying, but some other person got interested and he buys at 100.7. Maybe he buys at 101. Now, looking at the movement from 100 to 101, let's say someone else got really excited and she wants to buy at 101.2. So you understand what's happening? You understand what happens? This is a very, very typical nature of stock market or any asset classes. You take a look at the graph of any asset class. It can be Nifty, stocks, gold, Bitcoin, and you'll find that when the asset class comes down, people's interest goes away. But when the same asset class goes up significantly, a huge number of interest comes back. A lot of people show interest. Volumes at this stage is very, very high. When Bitcoin was at 9,000, no one used to talk about it. Now you open up any financial websites or anything, you'll see how Bitcoin has gone up above 20K, it's 23K and all, and so many people are talking about it. Not only Bitcoin, Nifty, gold, dollar, stocks. When the going is really bad and it's down, volumes or participations is very, very low. No one talks about it. So what can we make out from this typical behavior of the market participants? Why do market players shy away, go away, do not show any interest when it's in a very bad downtrend? But then when the same thing, the same asset class is 2 times, 3 times or 4 times higher, more and more people jump in. If it's 10 times higher, more people will jump in. Why do people behave like this? And what can we make out from this typical behavior of asset prices? What we can make out from this behavior is that markets move based on emotions. When it's emotions, like Mitesh has said, greed goes into this, fear goes into this, hope goes into this. I say all the emotion goes into this. Grief also goes into this. Prices move on emotions and expectations. Prices do not move because some company won an order. Prices do not go up because the economy is doing very good. No, it's on the expectations. It's based on the emotions of those buyers and sellers that markets move up. Some company called Burger King recently, I think, got listed, and 100 rupee stock went up to 200. Do you think they are selling double the amount of burgers every day now? Of course not. Then how come the price goes up from 100 to 200? Because the buyers and sellers, the demands and the supply, the demand is so high, they don't mind buying at 10% higher, 20%. They think it will go to 300, 400, 500. That's why they're buying at 200. Or else the person who's buying at 200, why will he buy at 200? He thinks he'll go to 300. So it moves on emotions. And everything goes into this word emotions. Your anticipation, your expectation, your greed, your grief, your fear, your hope, everything. Okay? And that's exactly what we are going to do with technical analysis. The beauty of the subject of technical analysis is this, that we are going to focus on this emotion. That is, we are going to focus on the price, right? To understand this a little bit more, to understand this little bit, in a little more detailed manner, let's quickly draw some differences between technicals and fundamentals, and then I'll talk about few basic reading material, books and websites. So on my left, let's say we talk about fundamental analysis. Okay. And on my right, let's talk about technical analysis. Now, fundamental analysis is more about or everything to do about the company. Technical analysis is all about the stock of the company. If you find this little weird, if you think that stock and company are the same thing, then they are not. The company is different, the stock is different. If you want me to show you the difference, let's show you with the help of a chart. Now this is tradingview.com, which I'm showing. I'm using a chart using tradingview.com. About softwares, we're going to talk in details, maybe in the second half today, or I'll save it for tomorrow, depends on the flow. Never mind. What we'll do is I'm going to open the chart of Reliance Industries in front of you. I'm going to open a slightly long-term chart of Reliance Industries in front of you. Okay. And let's try and understand the difference between stock and company with the help of this simple chart. This is a long-term chart. This is a monthly chart. What is a monthly, daily chart, candlesticks, line, bar chart? All these things I'll explain today itself, step by step. But let's understand the difference of company and stock. Let's say you got yourself, you bought Reliance Industries during, let's say, 2003. Yeah, this is mid 2003, somewhere here. You got it at, let's say, at that point of time with an adjusted, it's around 100 rupees. These are all adjusted rates. Let's say 100 rupees. And you held on to this from 2003, 4, 5, 6, 7. Let's say 4 years. You held on to it for 4 years. Let me draw an info line. And this gave you a return of around 628%, and you sold it around 760. Let's say you needed some money, and close to 700, 750 levels, you sold it. Okay, so you got exceptional returns. Hold on 1 minute. Let me delete this info line. Yeah, so you got some exceptional returns holding on to the stock for 4 years. You held on to it for 4 years and you got a good move. Okay, now you were lucky on your exit. The market tanked after that. 2008 happened. You got saved, and then slowly the Reliance stock stabilized, and then now you're free from whatever financial need requirement was there. It's all taken care of. Now you find Reliance again trading close to the 450 mark, 450 mark. Now you had a phenomenal run. You had a phenomenal success in Reliance Industries from 100 to 700 rupees, 7 times over a period of 4 years. Now you find the same stock, the same company trading at around 450, and you have some money with you which you would like to invest. Of course, you will not hesitate to invest in Reliance because the same company has given you phenomenal return. So why will you hesitate? And easily you can give yourself 4 years time, because last time you get 4 years, it gave you phenomenal returns. So let's say this time also you bought at 450 and you gave yourself 4 years time, 2009 to 10, 11, 12, and let's say 13. 4 years. You bought at 450. After 4 years, you find the same thing at the same stock at 450. It went up a little bit to 570. It came down a little bit to 350, but then end of 4 years, it's still at 450. Not just 4 years, for another year and another year and yet another year. So if I see this from 2009 all the way till 2016, almost 7 years, for 7 years, the stock didn't go anywhere. Now, is this a good investment? Not at all. It's a horrible investment. But wait a minute, the same company, didn't it give phenomenal return just in 4 years, few years back? Yes. It's the same damn company. But now this time I've given not 4 years, I've given 7 years. People say equity is a long term, it's like wine, jitna rakhenge utna acha, etc., etc. Come on, I'm holding on to it for 7 years. 7 years. If I've put this money in some other stock within this 7 years, I would have also got 7 times. Something like an Eicher Motors or an HDFC Bank. Now, is this a bad company? During 2010 to 2009 and 2016 and 15 and 14, was Reliance a very bad company, a horrible company? Of course not. But then if I rephrase the question again, during 2009 to 2016, was this a horrible stock? You'll say, yes, ask me. It's been a horrible stock. It's a fine company. It's going through some structural changes. They're planning to get into telecom and they're making some expenses. And that's why the stock just doesn't move either up or down. So is it a good company? Yes. Is it a bad stock? Yes. And now look at the situation now. Is it a good stock? Indeed, it's an amazing stock. Is it a good company? Of course, it's a good company. So we need to understand that it can be a good company, but for you to make money or lose money, it's the stock that needs to move, right? So companies and stocks of the companies goes through these phases of, let's say, correlation and non-correlation. When the company is good, and this, it should reflect on the price of the stock. And at times when the company is good, but it's not getting reflected on the price of the stock, right? So the main key difference between technicals and fundamentals is fundamentals pay attention to the company and technicals pay attention to the stock. When I say pays attention to the company, fundamentals will pay attention to the balance sheet. It will pay attention to the profit and loss figure. Of course, the most important thing, as far as I understand, is, as per my experience, is the management. Management is the key thing when it comes to fundamentals. You know, you can give an amazing company to an incapable management and they'll turn the amazing company into a wrecked ship. And then you give a distressed company, a completely down the drain company with nothing in it, to a capable management, a capable set of people, and then you will see a turnaround. How many times we have seen this happen, up to down and down to up. So yes, the industry matters, yes, the company matters, but then what matters the most is the management. So when it's about company, when it's about fundamentals, all these things matters. Their orders, their quarterly results, what kind of products they are into, the global demand of the product, and so many things goes into fundamental analysis. But then when it comes to technical analysis, there's only one thing to look at: price and nothing else. And say, what, you think you're some kind of James Bond? You're not going to look into the, let's say you're talking about Reliance Industries, and you're not going to talk about Jio, you're not going to talk about their refineries, you're not going to talk about their future plans. You're only going to look at the price of Reliance, and you would be a James Bond, and you can say when price will go up and come down. Well, the technical analyst says, yeah, why not? So what's the rationale of that? Why don't you want to look at the balance sheet? Why don't you want to look at the management or the order flow? Why are you being such a snob that, come on, you do all the hard work, I'm going to only look at price? Why? Well, the answer to this is fairly simple. Is that, let's say you take up the mutual fund industry, the institutions, okay? And they are going to research upon all these aspects of Reliance Industries. After doing all this, which is essentially, what are they doing? They're analyzing. This is analysis. After doing the analysis, what is the action they're going to take? They're either going to buy, or they're going to sell, or probably they're not going to do anything. If they buy, they will inject what? Demand. If they exit, sell, what will they bring into the system? Supply. And there this will be no movement at all. When there's demand, what will happen to price? Prices should go up. When they bring in supply, what should happen to price? Prices should come down. And when they're not doing anything, what will happen? Prices should stay stable. So why do all of these things? Why don't we just cut the crap and just focus on the movement of price? If we find that the movement of price is positive, is on the upside, why is it going up? Demand must be greater than supply. Why is demand greater than supply? Now I'm doing a reverse calculation. Prices are going up, uptrend. Why is it in an uptrend? Because people are quoting a higher and higher price. Demand is greater than supply. Why do we think demand is greater than supply? Because people who are buying, they expect that it will go, they will sell at a much higher price. And so they're quoting a higher price. Demand is greater than supply. And so if we just look at price, how did they reach the stage of demand? They might have done their own analysis. Some advisor must have told them, whatever they must have done, technicals or fundamentals or astrological or whatever be it. Bottom line, end of aap kuch bhi ukhad lo. The bottom line is when you come to the markets, you're either going to bring in demand or supply, or you will not do anything. The retails can do it in hundreds and few hundreds of shares or thousands of shares. The HNIs might be able to do it in 10,000, 20,000, 50,000 shares, and the institutions can do it in lakhs and lakhs of shares. You may have a portfolio of 10 lakh rupees or 1 lakh rupees. The mutual fund may have a portfolio of 10,000 crores or 40,000 crores. That's the only difference. But when you're buying, you're bringing in demand, and when they're buying, they're also bringing in demand. And so that's why the technical analysis only focuses on price. There's another aspect of technical analysis which I really like, that is any market. Once we understand the theory, once we understand how to analyze, how to read a chart, we can not only read the chart of Reliance, we can read the chart of Tata Steel, which is in metals. We can read the chart of ITC, which is in, let's say, FMCG and consumer play. We can read the chart of DLF, which is in real estate. We can read the chart of Hindalco, which is into metals, aluminium. We can read the chart of Bitcoin, which is a completely different breed, cryptocurrencies. We can read the chart of gold, dollar, euro, yen, platinum. So the point is, if I understand this theory well enough, I don't have to be restricted to just one sector or one country or one asset class. If you're a fundamental analyst, then you won't be able to do fundamentals of all the sectors and all the countries and all the asset classes, because you might be very good with banking sector, but the fundamentals of the telecom sector is very different. You might be very good with Indian equity, but the Bangladesh equity or the US equity or the Australian equity markets can work little differently. You might be very good with global equity, but then fundamentally you may not understand global commodities or currencies or cryptocurrencies. So you understand that the fundamentals are really important. They're really good. They are the pillars of the market, no doubt about it. But then technicals does offer us to look at multi-asset classes with the same theory. I do not need to do a separate technical tool to trade cryptocurrency. The same chart, the same tools, the same indicators can be used to trade a Nifty or a Bitcoin. So we can look at any market. Another amazing feature of technicals is any time frame. This I find very, very fascinating. Any time frame. Any time frame means we all here in this batch are unique, different in nature. If I am a positional trader, I hold on to my positions for a day to, let's say, 5 days to 5 months. There can be people amongst us who are primarily intraday traders. They don't want to hold on to the positions for more than 15 minutes or 30 minutes. Or there can be people who want to do medium to long term, let's say weeks and months and years. When it's about fundamental analysis, it is primarily long term in nature, because fundamentals of a company, fundamentals of an asset does not change overnight or over a week. It is more or less stable, and then you look at quarterly results. You evaluate once in every 3 months. But then when you come to technicals, which is price driven, the price changes every day. So what the price was last month and what is the price today, there can be a big difference to that, positive or negative. And if there's a big difference, there will be a big difference in your decision making. And so with the help of technicals, if someone wants to do intraday, he or she will be able to do intraday trading using technicals. If you want to do positional, you will be able to do using a different time frame. If you want to do long term, that is also possible. But with fundamentals, that is not possible. With fundamentals, you're generally looking at medium to long term positional trades only. So that's more or less the difference, the major key difference. I happened to write only once. I was approached and I did so, write about biggest strength. What was the title? Biggest strength of technical analyst? Yes, this one. You can let me copy this. Biggest strength of a technical analyst. I'm going to share this with you on this. Yeah. So you can read this. I had written this quite a few years back. This was in 2017. Ads have started coming. So in this, I had written about what is the biggest strength of a technical analyst. So feel free to read this. This might be a good help. Okay, let me quickly take a look at your questions. How to identify the capability of the management? How to identify the capability of management? Good question, Shubham. Track record, very important. Beliefs, lifestyles, speeches, letters to their investors, the ethos, the beliefs in which they follow. For example, I don't know if you have ever seen Vijay Mallya's lifestyle. Larger than life. That's how he projected himself. Did exceptionally good for himself, right? Till a certain amount of time. But then, if you were an investor in KFA, I don't know if you know what is KFA now. If you ask the SBI Treasury the amount of money they had invested in KFA, that's not the way a company should be run by a management. You can look at and listen to the key people who are running the show. You can listen to a Narayan Murthy who used to run an Infosys, right? So try and understand their beliefs. Track record also plays a very, very important role. So you need to get into the nitty-gritties of their decision making. Why did they take such a decision? Okay, so you have to follow the company really well to understand the people who are running the house or running the ship, right? Company may be good or bad, performing based on financials, but stock performance is based on market forces. That's exactly the point. And market forces is essentially demand and supply. And this is the demand and supply which you and I are going to try and read out of these charts. The work of a technical analyst is to understand this market force. Cut it down in let's say the bottom line. So if we look at this chart of Reliance, the market forces is on the upside. I don't need any technicals, or I don't need to read any books of technicals. I can just visually see this and I know the prices are going up. So the forces are on the upside. So demand is greater than supply. But that's not enough. That's like my 5-year-old son can also say this. But the important thing is, the most important thing, this is where we make and break, is where is it heading from here? What do you think? Is it going to go up or is it going to come down? This is where the millions are made and the millions are lost. Until and unless someone loses, how the hell is someone going to make? So that's very natural. If someone makes, someone loses, and vice versa. So that's a very, very, very natural aspect. Not a problem with that. So what we will try to do with technical analysis, and it will be my responsibility to guide you through the first 6 classes. And when you look at the same chart at the end of the 6th class, you will be able to answer this simple question. You will be able to analyze the chart with clarity, and you will be able to answer to yourself, should I buy, should I sell, or should I wait? I think that's enough to answer to yourself for the next step. If you answer yourself, should I buy, then the next questions will also be answered. At what price should I buy? If the answer comes, should I sell, then also at what price should I sell? And if the answer comes, should I wait, then you wait for prices to develop. But if you follow what I'm saying, if you do the necessary practice, then at the end of the 6th session, you will have clarity to answer this to yourself. What should I do? How have I analyzed this chart? You will be able to do that. Now, one more small thing. I just said 6 sessions of 2.5 hours each. Honestly, tell me everyone, 6 into let's say 2, 12, let's say 15 hours. Do you honestly think that in 15 hours, you'll become an expert in technical analysis, that you'll be able to analyze each and every chart that is thrown at you? Is it possible? No, right? It is not possible. What I'm saying, the way I'm explaining, has got built up over years. I started reading and looking at charts and watching charts almost day in, day out since 2004, mid 2004. So I'm looking at a 16 years, not much, 16 years of experience. 16 years of experience, and I'm telling you, in 16 hours, you'll be able to do that? So of course, you've said that it needs a lot of practice and it's not possible, never, etc., etc. Now let me tell you, I know that I have a limited time to share with you during this live classes, of course. And so what I have done over a period of time is, let me find my YouTube channel. Yeah, so I'll come down here. This is the link to my YouTube channel. So what I've done over a period of time is I have created many videos on technical analysis, its various nuances, and I've uploaded them on YouTube. I am not a YouTuber. Okay, I have no interest to become a YouTuber. I use YouTube as an ancillary, as an annexure, as an ancillary building. So I'm gonna take 2.5 hours of class with you, and I will tell you, it will be like a homework to go through, let's say, 3 videos, and the 3 videos will add up to, let's say, 1 hour. So in total, you will be listening to me for not 2.5 hours, 3.5 hours. At times, the videos can be more than 2 hours. So I took 1 session with you, but together, once you watch all the videos, it will be 2 sessions. All right. So like this, in every class, when I take up each and every topic step by step, I'm going to share links of few videos which I'll expect you to watch. And when you watch them carefully, maybe once or twice, it's not going to be 15 hours. It's going to be far more than those 15 hours. Smart, yes, thank you. But there's a catch. The catch is, You have to do that. Unless and until you do that, you will not be able to analyze this chart with clarity the way I am, let's say, claiming that you will be able to. Or else batch number 41 wouldn't have been possible. So trust me, please do as I request you to, follow few steps, and when I'm done with my session, you will be able to analyze any chart thrown at you. Okay, now 2:43, let's put in some more time. Let's talk about few time frames, the types of charts, and then we'll take a break. Post the break, we'll go to Dow here. Now this is a two-dimensional chart. We spoke about 2 dimensions of price and time, open, high, low, close. Now this price information can be broken down into various time frames. One day means each and every of these candlesticks is made up of one day. So this was Friday, 18th December. The previous candle is 17th December. The previous one is 16th December, 15th December, 14th. This was a Monday, so previous Friday, again 11th. Each and every day, each and every candlestick is a day. I can change it to week. Now this is the week ended last Friday, which is 14th December. This is the week ended on 7th December. Now please note each and every one of them is now a week. Like this, we can have month, week, days, hours. Let's say 1 hour, or let's say 15 minutes. Each and every of these candlesticks is of 15 minutes. After 15 minutes, there's a new candle. After 15 minutes, there's another new candle. These are the various time frames in which we can plot the price. And that's why an intraday trader will only focus on 5 minutes, 15 minutes, or 30 minutes. He will not look into a weekly or a monthly chart. An investor will not look into a 5-minute chart or 15-minute chart. It's not for him to do that. He will look into a weekly chart or a monthly chart. So you understand that technical analysis can be practiced in various time frames. You choose the time frame which suits your risk appetite, your style of trading the best. How do we get to know this? The best method is try and test it out yourself. I'll guide you in that. The other way is, what are the different ways in which prices can be plotted? The basic of all is the line chart. This is called a line chart. The line chart plots only the closing price, It does not show the information of open, high, or low. Only the close price. This was the basic chart. The first chart you can say is this one. Then within a period of time, slowly, now we have open, high, low, close. This is called a bar chart. It's like a stick. It's like a stick wherein it has a straight vertical line. The lowest point, of course, is the low. The top point is the high. Then it's got a left tick. This left tick is the open, and the right tick over here is the close. If you look at the bar chart, you find a long red bar. The close to close basis, this close is lower than previous close. And then the Japanese candlestick chart. The Japanese candlestick chart is far more ancient than the bar chart or the line chart. We will dedicate one full session, which is, I think, our third session next Saturday. Full session we will dedicate to this candlesticks, and we'll talk about Heikin-Ashi candlesticks also. Both of them will be dealt in our third session. Apart from the line, bar, and candlesticks, there are a few more. There's Renko, line, break, Kagi, etc., point and figure, range charts. But those are not necessary right now. For us, we just in a basic program. We're talking about technical analysis. We are just understanding, we're just scratching the surface with demand supply. We have now understood that prices, there's a difference between stock and company. This understanding is very important. That's been taken care of. It's primarily based by emotions and behavior. It's the emotion that leads to the behavior. The behavior is buying and selling. The emotions can be greed, fear, hope. So we've understood that. And so we're not going to put in a lot of effort in what products or services Reliance is into. No, we're only going to focus on the behavior of price of Reliance Industries. How is the price of Reliance Industries going to behave, right? And that's the core of the first section that we have done. Now, after the break, we'll move ahead and we'll go to the first theory of technical analysis, which is called the Dow theory. But before that, let me quickly check any questions. So why do you like to use hollow candles in trading view? Good. I would love to answer this question, Aditya, on the fourth day. It's my request you ask me the same question on the fourth day, especially when I do the relative strength index, the RSI indicator. If I answer your question now, it will be half of an answer. And you may understand, if you have read a bit about technicals, you may understand my answer, but it's not fair for the others. So I would only say something so that everyone understands, or else there's no point to sound intelligent. Okay, so it's a request, ask me on the fourth session, especially when I'm done with a relative strength index. Bodhishatta has got a question. Respected sir, I have a question. Does put call ratio also a measure of demand supply dynamics? So put call ratio is also a measure. Yes, indeed, it tells you the positions or the volume, the value of the positions on the bearish or the bullish side. Based on that, a ratio is calculated, based on which, of course, you try to understand, gauge the dynamics of demand and supply. Yes, you can say that, let's say if you take a look at the temperature, and someone was saying in the WhatsApp group, I looked at, will there be a break because I would like to sit in the lawn and enjoy the sun and the class? Amazing. So of course the temperature at his end is, let's say, sub 15 or something. So he's feeling cold, it's cooler there. So likewise, it is a barometer. It's like you can gauge to some extent the demand and supply. Need not go right all the time. Okay, need not go right all the time. You need to know how to read them. That's also important. Okay, having said this, let's take a break. I think so far so good. If I've gone too fast or too slow, do feel free to put it there in the chat box. Let's take a 12-minute break. We are heading towards 2:51. So 9 plus 3 makes 3:03. So I'm going to join you 3:03, 3 minutes past 3 o'clock, and we'll take up the Dow theory. Thank you. All right, so let's continue from where we left. Let's first talk about few basic reading materials, and then we'll go to Dow theory. Now, if you're completely new to the subject, and probably this is the very first time that you've got yourself exposed to technical analysis, then you got to do a little bit of reading. Practice is something that needs to go on parallelly. John J. Murphy's book, Technical Analysis of the Financial Markets. This is, I feel, that an ideal book for any beginner. At the initial level, at the beginner's level, there are many books. There is Martin Pring's Technical Analysis Explained. There is Kirkpatrick and Julie Dahlquist's Technical Analysis. There is Edwards and Maggie's Technical Analysis of the Stock Trends. But I feel, having gone through all of them and more, I feel that a good starting point is John J. Murphy's Technical Analysis of the Financial Markets, primarily because of the way John J. Murphy has approached chapter by chapter, and the simple usage of the language. No fancy words, no difficult words, decent sized book, decent font size. I think everything fits in well with this book for a beginner. You don't want to get bogged down, disappointed, or demotivated, or too difficult language, especially when you're starting off something. I feel that there should be enough carrot brownie points given to you so that you stay in the game, so that you stay inspired and motivated, and then take up a slightly little more different book. So Technical Analysis of Charles Kirkpatrick and Julie Dahlquist is a very good book, but I don't think it is ideal for a beginner. I think it's a refined book. The way it has approached the subject is a little different, and I feel that's why John J. Murphy is an ideal one. Okay. Edwards and Maggie is a classic. It's a classic. It was written very many years back, and I think it should be in its 10th edition or maybe more. A classic. Language is not difficult, little different because it was written many years back. It's a classic book. It's like a classical technical analysis textbook. You can read this later, but I would always suggest to start off with John J. Murphy. Now, as we progress with our classes, I have 6 theoretical sessions with you and 1 practical session, right? Now, as we progress in our sessions, every session we are going to look into, understand something new, okay? And we try to specialize on that. For example, today, the first part, we have spoken generic markets, exactly what is the underlying ethos of technical analysis, what is the subject all about. And then now in the second half, I'll be talking about Dow theory. Now, if you want to if you want to dive a little deep, into Dow theory, then you can read Robert Ray's The Dow Theory. This book, from the first chapter to the last, deals with Dow theory. So you can say this is a specialized book. You should take up these specialized book, I think, once you have managed to go through the basics and a little bit of all. Like, for example, this book of John Murphy is like a lunch buffet, or like a, let's say, an Indian thali. It can be a Rajasthani thali or South Indian thali, doesn't matter. But when you go for a thali or a buffet, you get to expose yourself to a lot of different tastes. A lot of items, food items are there, right? And then you will tend to see that you will order, or you would go and fetch more of something which you like a lot. So John Murphy's book is like a thali, is like a lunch buffet, where around 17 or 18 chapters he has explained a little bit of everything. He has explained a little bit of philosophy of technical analysis, a little bit of supports and resistances, a little bit of indicators, candlesticks, Fibonacci, a little bit of everything. But then the book has not gone deep into any one particular thing. That's not the objective of the book. It's a textbook. This is a specialized book, right? So like this, as we go on to the next day, and then let's say when we do candles also, we will look into some specialized books. Okay. Can we get a list of all the books, Akhilesh? So I'm just saying you can, anyways, these videos will be with you. Just keep a note. Every day I'm going to share a new book with you. So when I finish it, you'll have the list with you ready. Okay. Best book for behavioral economics. Now you are deviating a little bit, Jyoti, from technical analysis to economics. Behavioral economics, I'm sure there are many books. Even I have read them, me being an economics graduate back in 2000. But I don't remember any particular author's name. I'm sorry, it's been 20 years. So I don't remember any book on behavioral economics, but I'm quite sure there'll be many. Now, coming to the first theory of technical analysis is the Dow theory. Dow theory is named after Charles Dow, who was the founder editor of the Wall Street Journal. Wall Street Journal, even in today's date, is a very reputed financial journal. And I'm talking about 100, 120 years back, he started this. Okay. And at that point of time, what he did was he created two indexes. So let's say Nifty is an index, right? Nifty 50 is an index. It is called Nifty 50 because it's an index made up of 50 stocks. 50 stocks across 13 to 14 different sectors. And so the value which we see today as, let's say, 13,700, that value is an average. It's an average value, right? So 100, 120 years back, when Charles Dow started this Wall Street Journal, what he did at that point of time, he created two such averages, the industrial average, and the transportation average. Of course, in industrial average, what he did, he took few reputed names of those companies who are into that sector. And then he took transportation stocks in those years and he created an average. I think he took some 20 each, or I think 25 or 30 each. I don't exactly remember how many he took, but it was a group of stocks. And then end of every day, he used to find out the closing price of each and every of these stocks, the closing price. And then he used to sum it up and divide it by the number of stocks. And he got the average. Same thing he did, he calculated the average end of every day for the transportation stocks. And what he did, he took a graph sheet, he created a two dimensions. He took price in one of them, he took time in one of them, and end of every day, these are, let's say, every days, he used to plot what was the average price. And then what you can do is you just join the dots like this, and what do you get? You get a graph. You get a chart. And what he did, he observed these charts over a period of time. And he wrote down his observations, what he observed in these graphs. He wrote down in Wall Street Journal. They were readers of his journals, they were followers of him. And later on, after he passed away, his followers collated all his work, combined them, and published what today we know as the Dow theory. He never wrote anything called the Dow theory. He just published in his journals his own observations on these industrial average and transportation average. He did a phenomenal work. It was so phenomenal, and we are grateful that even today, when you look at what is the US markets doing, you do look at the Dow Jones Industrial Average. This is that Charles Dow. So the legacy stays behind even after hundreds of years. That's the kind of work a person does. And so our work today, rest of today's session, we will be looking into what are the 6 key pointers, the 6 key elements of the Dow theory. These are called the 6 tenets of Dow theory. The first tenet is an extremely important one. It is the cornerstone philosophy of technical analysis. Tenet number 1. This is not per se technical analysis, but the behavior of the market. This is more about the behavior of the market, this particular tenet. The first one to begin with. Price discounts everything. Price knows everything except the act of God or the except acts of God. This also will get within the price in few years' time. Let me explain this to you. This might sound a little off. When I first read this back in 2004, I did not understand. Of course, at that point of time, when I started reading about the subject, there were no academies, there were no courses, offline, online, wherein I can go and ask these questions. There was only one in BSE, Bombay Stock Exchange. On the top of there used to be a BSE Institute. But then at that point of time, I couldn't afford to attend such a training program. So all that I could manage was to reread and not understand. Then finally, the aha moment comes when you see it on the charts and then you understand, oh, now I know what it means. Experiential knowledge or experiential understanding. Let me try my best to make your life a little easier. Let me try my best to explain this to you. Price discounts everything means price knows everything. Whatever is the price today, everything related to that price, to that company, to that sector, whatever price you're looking at, is already there in it. If tomorrow a good news comes, then that good news is already there in the price today. So if the price goes up tomorrow, don't think that it's because of tomorrow's news the price is going up. Price behaves on expectations, anticipations, not on present facts. Let me try and help you this little more. How does it work? How does it happen that the price knows everything? You're saying that tomorrow a good news might come in a particular stock or a company or a sector. That stock already knows this? Yes, high chance it already knows that. How is it possible? It is possible via a group called insiders or an insider. Insiders or insider is a group of people who have privy to certain information which the general market, the general public does not have. I generally take a very simple example to try and explain this with you. Let's say, let me take up any name. Is there anyone in our batch who's, let's say, 25 to 30 years old, male, a guy, not married, 25 to 30, not married, anyone? 25 to 30 age group, you're not married, you're a guy, Akhilesh. All right. So let's say Akhilesh I'm going to make some assumptions with Akhilesh. So Akhilesh, please bear with me. Akhilesh, let's say has finished his studies and all the necessary societal studies, whatever it is, has done, and he has managed to get himself a job in Akhilesh, you're from which city, by the way? If you can tell me the name of your city. Delhi. Okay, so he's managed to get a job in, let's say, in his city in Delhi or little outskirt of Delhi, Noida and all, and where he's working, he's joined in a well-reputed company. For the last 2 years, he's working. So friends are saying, Akhilesh, tera to set ho gaya sab. Something like that is shaping up for Akhilesh. And so Akhilesh happens to meet in his office, let's say, Tanu. Okay, let's say. I know you may not like the name, but just to make a little more fun of it, just to make the conversation a little light. So he meets Tanu, and Tanu is also working in the same company. They are friends for the last couple of years. They've got to know each other really well. And now they are closing in their 28 and 29, and they think that, okay, this looks like a good opportunity. This looks like a good deal. We can get married and we can spend the rest of our lives together. Let's see how it plays out for us as a committed couple, something like that. Okay. So Akhilesh, आपका तो set है जी सब कुछ. Now there is more to this. Tanu happens to be the daughter of the CFO of a reputed Indian information technology company. Okay. And this CFO of an Indian reputed information technology IT company, let's say, is in talks with a Swiss IT company for the last 1 month for some kind of a merger between the Indian company and the Swiss company. And ये सब बातचीत last 1-2 हफ्ते से चल रहा है. The public doesn't know about it. The top management of the two companies, of course, knows about this. The CFO knows about it. CFO's daughter knows about it. And to be son-in-law, Mr. Akhilesh, knows about it. And if this merger goes through well in the next 1 or 2 months' time, agar sab kuch theek thak ho gaya, then this is going to be a big boom to the Indian IT company. And the Indian IT company, which is listed on the exchange, will see a big move. Agar ye chal gaya to, if this merger gets done. No one knows about it. It's an insider information. People are not allowed, top management is not allowed. They should not ideally disclose it to in public domain. Of course, the family may know. All right. So what will Akhilesh do? Akhilesh knows that these two companies are in talks, and in 1 month's time, the news should come out that this merger is done with. It's a big positive news for the company. And so what Akhilesh will do is he will create a demand. He will buy. Buying creates demand. And this is like a jackpot. This is like a jackpot. He's getting married, the girl is rich, and the rich girl brings in a once in a lifetime opportunity. तो आपका तो बहुत ज़्यादा ही set है जी, something like that. So he will buy. He will buy not only just 1 or 2 shares, he will buy as many shares as possible, because this is like a sure shot. He knows. And so demand will be created. Akhilesh is, of course, not the only person in this insider information. Of course, there are few other people involved as well. And so there's demand created, which will lead to the stock price from a certain price level to slowly drift up. And you'll find that the stock price is going up. We will see in the charts the stock price is going up. But on the news, if you track, there's no news related to this information technology company. Yeah, the markets are buying, the markets are fine, and the stock is going up, etc., etc. But it's going up without any particular news. News is not creating the rally. And then all of a sudden, after a month or 2 months' time, when it's all done, the news comes, the big news comes. And you open the newspaper and you open the media channels and everyone is shouting big news for this company. This, the valuation of this will go up, and they're talking to the management. They're talking to the management of the Swiss company. It's a huge discussion. It's on the breaking news on the front page of your newspaper. The brokers get excited, the advisors get excited, the technical analysts also get excited. They see a big candle, big breakout, and they all jump to buy. And who will sell to them? Akhilesh and the other insiders will sell to them. That's why there's a very old saying in the stock market. It's a very, very apt saying that buy on rumors, sell on news. See, when the cat is out of the bag, when the news is out, most of the time, majority of the time, there's not much cream left in it because it was already there in the price. This depends whether that particular information has come out or not. I have personally seen multiple such examples, and I've also seen recently multiple examples wherein news hadn't come out, which led to big reversals. When the banking norms were changed, when the corporate taxation norms were changed, when the long-term capital gains came into in the financial bill, etc., it did not lead to this kind of price discounts, everything. But most of the time, when it is related to a stock, you will find this. It's primarily due to insiders, and it is also another reason is primarily due to expectations. Say, for example, there's election coming up, okay, and in your state, in your city, the political parties are doing their campaigns, and they are the same, the same breed, and so they're making claims that if we come into power, if you vote us and we become powerful, then we'll make roads cleaner, we'll get all the roads done, etc., etc. So all they will have some endpoints of agenda to do their campaigns. Fine. And let's say you vote for them and they come to power. And the reforms should begin. They ideally should live up to their promises, and they should be placing orders, giving tenders to infrastructure companies to lay down the roads. They should be doing it, right? The roads built yet, by the way. It's far, far away from the roads getting built. It's far, far away from the companies even getting the orders to lay down the roads. But then, can you create an expectation that, well, listen, if this political party comes into power, then they should do these reforms, and if they do these reforms, they should get orders, they should give orders to the infrastructure companies who lay down these roads. So let's check who are the companies in India who do this work for the government, and you find XYZ company who does this work. They are the key players, and so XYZ should get the orders and XYZ stock shares should go up. Isn't that a very simple expectation, logical expectation? Yes. And so if everything plays out that way, should you wait for the orders to get placed, then you will buy XYZ stock? Will you wait for the roads to get laid down, ready, inaugurated, and then you will buy the shares of XYZ? No, you will buy these shares of XYZ today on the expectation that this entire story will unfold, and if it unfolds, the price will appreciate, the company numbers will appreciate, etc., etc. And so you buy. You're not the only smart person in the market. There are n number of smart people in the market. They also buy. Altogether, the degree of demand is greater than the degree of supply. All of you want to quote a higher and higher price. The price automatically goes up. The trend is created. The price has discounted the news. This is called price discounts everything except the acts of God. Means if there is some kind of a natural show, a natural drama, like a hurricane or a cyclone or an earthquake or a tsunami, which can bring in economical changes. That as of now, price doesn't know. But I think with the passage of time, these things will also get discounted. With companies like Google laying down wires underneath the ocean's bed, you will today, in few years' time, we will get to know which part of the Earth is going to face a earthquake very easily, to a lot of degree of accuracy. And so slowly that part will also get taken care of. COVID, acts of God? Question mark. I think so. It's a mystery for me. Let's not go there. This current whatever situation it is, for me, the way I look at it is an unsolved mystery, and nothing more than that. It's gray right from the start till today. It's all gray. Whether the tests are accurate or not, gray. Mr. Elon Musk does 4 tests in a day, 2 positive, 2 negative from the same hospital, gray. Whether it was man-made or natural, gray. Whether it actually exists or not, gray. Some people get it, it doesn't show. Some people get it, they die in 7 days. Some people get it, they just drink water and hot water, they get fine. Gray. Today, as of date, you don't have any medicines to it. Vaccines, all the pharmaceutical companies, they're spending millions of dollars to get it. It's like a race, so that you get the government orders, so that you will see, I think if this goes through, you will see in the Forbes list of richest people, the pharmaceutical owners will come up very, very, very high on their ranks, because this is once in a lifetime, once in 100 years opportunity. Isko to cash in karna hi hai. And so it's gray, gray, gray everywhere. If you say it started from China, where is China? They are going to amusement parks today. You don't even look at 5, 6 more than counts there in China. So from where it started, that country is probably at the lowest end of the list, and the other companies at the highest. So it's all gray. Let's not talk about it any further, whether it's an act of God or not, but it's been created like that. That's tenet number 1. Now let's go to tenet number 2. Tenet number 2 is you should be analyzing the chart in 3 different time frames. The short term, the medium term, and the long term. The short term is also termed as the minor trend. The medium term is also termed as the intermediate trend. And the long term is termed as the major trend or the primary trend. I'll show you a chart how this is to be seen. Let me draw it for you at first. So let's say if you're looking at a primary trend which is going up like this. This is the primary trend. Okay. Or okay, I could have drawn this a little better. Just allow me to draw it. Yeah. So if this is the primary trend, within the primary trend, you will find that there will be intermediate trends. These are intermediate trends. The main trend is up, the intermediate trend is down. And even within the intermediate trends, there will be zigzags which are short-term in nature, very, very short-lived by few days. Right? And so those are minor trends. The intermediate trends are the ones which goes against the primary trends. And then the primary trend is the main trend. If you look at any chart, let's say over here, we are looking at the daily chart of Reliance Industries, then we can say from this point till this point, the primary trend was up. And then you can say that this was an intermediate trend on the downside. This was an intermediate trend on the downside. And then when you zoom in to look at the intermediate trends, within the intermediate trends, there will be short-term movements, short-term gyrations. Those are minor trends. So you should be looking at it, looking at the three different time frames: short, intermediate, and long term. Talking about time frames, okay, I'm going to share with you YouTube links of two videos, which I would request you to go through before, over the weekend or next week also you can go through. Let me find these videos for you. It should be under LSD. Let me check. Okay, best intraday time frames to trade. Sorry. Best intraday time frame to trade. Number one, please take a note of these links, which I'm pasting over here on. What I can do is I can parallelly post them on your WhatsApp. Wait a minute. Batch 41. So please go through this video. I've posted on WhatsApp as well. This is a video wherein I talk about the best intraday time frames to trade. Then there is one more which I created, how to decide the best intraday time frame for any exchange. This is primarily to figure out the logic, how we should define our time frames. For the newcomers, I think I should have a video which I created, how to make a career in stock market. Okay, how much capital do I need for trading to start trading? This is also a video which I request you can take a look. If you have these kind of questions in the back of your mind, then this is an important video. How much capital do you need? And okay, if you have this thing that how can I get my job, the salary from my from the market, then this is the next video that you should look at. Copy. So these are the 4 videos for generic understanding of time frames and approach towards the market. Okay. The third tenet of Dow theory, tenet number 3, is that of the 3 phases of the market. Not always necessarily all the charts will show that, but the 3 phases: accumulation, consolidation, distribution. Accumulation generally always comes after a big fall, when prices are relatively far more cheaper, valuations are far more attractive, and primarily the institutions find it really, really attractive to buy. They get into the stock, they buy into the stock, but the stock keeps on staying into a range bound behavior. This kind of a range bound behavior, wherein it can fall but not significantly like before, it's not in a downtrend anymore, but the stock gets accumulated. Accumulation is a staggered approach of buying stocks over a longish period of time, so that you accumulate, you keep on buying it in small parts, and then eventually the trend reverses and maybe goes into an uptrend and goes like this. Okay, I should have drawn something like this and leave it. Yeah, let's say the reversal happens, it's a turnaround which happens, and then At the top also, you will find that the stock goes higher and higher just to correct and come down. This is distribution. Distribution is that range bound behavior of price, wherein it does not trend as much as it used to do before. It's not going up as much as it used to earlier, but now it's kind of staggered. It's going up, but in a very slower and lower pace. It's getting sold into. That's distribution. And the third one is consolidation, where essentially it goes nowhere. It's like a midway of the trend, consolidation. You will notice few aspects of this drawing. We'll see them in the charts tomorrow when we do patterns. But few aspects of the chart you will find is that accumulation always leads to a reversal of downtrend. Post an accumulation, it's a down to uptrend. Distribution, you will notice, always leads to a reversal of uptrend. So distribution and accumulation, both of them are leading to a reversal of the previous trend. Consolidation leads to, if you notice, a continuation of the trend. Before consolidation, the trend was up, and after consolidation, the trend is again up. So consolidation leads to continuation, but it is accumulation and distribution, both of them, which are leading to reversal. We will keep this as it is here, because tomorrow when we talk about support, resistance and price patterns, we will be talking about reversal patterns, we will be talking about continuation patterns, and that is when we will take this up yet again. The accumulation, the consolidation, the distribution, how you can differentiate them. Just remember one more very important thing. I'll write them down to be useful for you. Very important thing. Volumes are generally very high. Volumes are high. Volumes are very, very low. This is also a very important differentiating parameter between a consolidation and a distribution. The market is going up, it goes range bound. The market is going up, it goes range bound. And you have a question, is it going to continue? Is it a consolidation? Or is it going to reverse? Is it a distribution? How do I know? One simple way to know this, or at least to anticipate, is by looking at the volumes that is going inside it. If the volumes are high, it can be distribution. If the volumes are low, pretty low, pathetically low, then high chance it's a consolidation. We will be talking about this in detail when we talk about patterns tomorrow. Okay, and so I will move on to the fourth tenet, which is volumes to confirm price. Before that, I can see a couple of questions. Anjali's got, can we describe the accumulation period for Reliance for years 2009 plus 7 years? Well, it was too much of an accumulation. Matlab, that stock had squeezed out the patience of each and every one from the market. I would not call it exactly an accumulation, because accumulations cannot last for 7 years. We cannot call it, we can call it consolidation. We can call it consolidation. There was not a well-defined trend before it, neither up nor down. It was just, in simple way, if you want to understand, it was pure vanilla time pass. It was just consolidating before it decides now is my time to move. And that's why when I started tenet 3, I said that in every chart, we will not find it beautifully the way I've drawn it. See, theory is for us to understand, And when we go to the practical aspects and we look into the charts, we will be bombarded, we will be exposed to variety. Okay. How many of you went through driving school to learn how to drive, right? And then when you finished and you finally got a license, and when you started driving in the real markets in real peak hours, it was different, right? The feeling was different, but with practice you got better. And so that Reliance example is more like just pure vanilla consolidation. We'll talk into this. We will talk about this driving part also in detail later, maybe tomorrow. Why this uptrend happens all of a sudden? See, Anamita, uptrend doesn't happen all of a sudden, or uptrend doesn't have to happen over a period of time. The uptrend will happen when it has to happen. Few stocks, all the stocks are very, very unique in nature. You look at your friend circle, you might have a close friend circle of 5, 6, or 4, or 3. You'll find that, yeah, you have similar likes and dislikes, but everyone is unique. Like that, every stock, every chart is also very, very unique. One stock may trend very fast, fall very fast. It's a very volatile stock. And the others can be very, very slow and steady. All right. So we cannot just put in say that only one rule applies to all of them. The more we look into charts with more classes, we'll understand this better. Now let's go to the fourth tenet, 4, 5, 6. Tenet number 4. Volumes to confirm price. This is something that I do not believe in, but I don't judge the tenet also. This tenet was observed and written back then when there was no derivatives, there was no arbitrage, there was no options or futures. It was primarily a cash market. People give money and they buy the stocks, and then slowly, of course, there was derivatives, there was shorting and all, but not to the extent that we see today. There was no algorithmic trades also. And so the play of volumes today is very different from what it used to be when this tenet was observed. What this tenet says is that if you have found a primary uptrend like this, then you will see that this is the primary uptrend, right? This is the primary uptrend, okay? And in this primary uptrend, you will find that the primary legs on the upside is this, and this. These are the 3 primary legs on the upside, in line with the primary trend. And then the 2 legs on the opposite sides are this and this. Now let's understand the play of volume. So what the tenet says is, if you look at the behavior of volumes in this manner, then you can say volumes are confirming price. And what is the manner? When the price is going up in line with the primary trend, let's say volumes are something like this. On an average, volumes are in this level. Now, when the price falls, that is against the primary trend, the volumes should shrink, the volumes should die down. And then when the price picks up again in line with the primary trend, the volumes should pick up. The volumes is higher than when the price was down. Again, when the price falls, volumes should come down. Again, when price picks up, volume should also pick up. So when you look at the behavior of volumes and compare it, how is the volumes when prices are going up vis-a-vis how are the volumes when prices are coming down? When you do this comparison, and if you find something like this, you can say, okay, whenever prices are going up, volumes are picking up. Whenever prices are coming down, volumes are slowing down. And the primary trend is up, then this means volume should confirm price, means there is participation of volumes. However, in the last leg, if say for example, volumes were very low in the last leg, if this had happened in the zone, then you would have said that, wait a minute, volumes are not confirming price, volumes have died down. So a lot of market participants are not participating in this leg. This is not a good sign, the prices will correct. This is classical theory. When we look at price charts, honestly, this is not something you will find often. No. In fact, many a times you will find huge volumes at the top and equally huge volumes at the bottom. These are called panic sell-offs. These are called euphoric buyings. Great big volumes happen and then it doesn't go up anymore. In fact, it falls. Huge volume happens and the market crashes. Technical analysts will say huge, big volume selling, the market will fall, and it doesn't fall at all. It just reverses and goes up. And we will look into this. We will look into this. Again, I am just building up today, sharing some basic theories which are there in your curriculum with some anecdotal stories, some analogies, so that you and I are in sync, the same page. But then the fun will start to pick up when we start looking into real charts, which will happen once I've built up some theory. Okay. Tenet number 5. I like this tenet. Tenet number 5. This is a very nice tenet because it helps us to track the markets really, really well. Tenet number 5 says should confirm. Okay, what does this mean? That averages from each other. An index, 50 index. Let's say Nifty 50 is going up. Nifty 50 is the top 50 stocks of the country. It is going up. It's in an uptrend. And then you would like to see, okay, what is the small caps or the mid caps doing? And you check the mid cap 50 or the mid cap 100. And you find that the mid caps is also going up. Very nice. You want to check what is the small caps doing or the S&P 500 is doing, the Nifty 500 is doing. And you find that one is also going up. So when you look at Nifty 50, which is just 50 top stocks, you find a certain trend, let's say up or down or flat. And then you like to confirm this. Let's say, okay, Nifty 50 is going up, means the top 50 stocks are doing good. Okay, let's find, is this happening in the broader markets also? Let's take up the mid caps. Oh yes, the mid caps are also doing the same thing. What about the small caps? Oh yes, the small caps are also behaving the same way. In fact, the top 500 stocks are also behaving the same way. What does it mean? It means that the averages are supporting each other. The averages are confirming each other. And when 50 stocks are going up and 500 stocks are also behaving the same way, it's a very broad market trend, a broad market rally, a very healthy bull market. But however, let's say, for example, after a few weeks, few months, the Nifty, let's say, starts to come down. And during that period, let's say your mid cap is still going up and also your small cap is still going up. This is not confirming each other. The smaller sections of the markets are going up, all right, but the top 50 stocks have started dropping down. Are they confirming each other now? No, they are not confirming each other. They are diverging. They're doing opposites. This is not a healthy sign. And so I find this tenet very useful, and you will find this approach, this typical approach of the tenet in one of my playlists. It's called India Market Analysis. What I do every week, I share a post on my take on the Nifty, on the Bank Nifty, and few sectors. And I've been doing this for some time. This post generally goes Saturday night at 8 o'clock. This is scheduled. This is going out tonight at 8 o'clock. Trend hard, party harder. And in this videos, there's a small 10, 12, 13-minute videos that I make every Friday evening with my community traders. And in this video, what I do is I look into the behavior of Nifty on a weekly perspective, and I also look into the behavior of the sectors. I find this very, very useful. So for you, if the markets is going up for 7 weeks now, you should want to know that which are the sectors which are supporting this market for 7 weeks, and which are the sectors which is not supporting, which is the sector which is probably not going up for the last 2-3 weeks. How will you understand? This approach of the tenet 5 helps us to do this. Very useful. Tenet number 6. Tenet number 6 is very simple. There's not much to talk about tenet number 6. It's simple. To put it in simple words, I would say don't predict or don't judge the trend, or don't anticipate a reversal. Means if you find a market, let's say current market is going up, right? Do not try and predict, okay, this is the top, it's going to fall now. Until and unless it shows enormous amount of information that yes, I have reversed, there is no need to judge, there is no need to predict, there is no need to call that the trend is over, because trends have a nature. It's easier for the trends by its nature to continue rather than reverse. You will find that for a smoker, it's far more easier to continue smoking than to quit and reverse and not smoke. You find any other trends within yourself. If you have a particular trend of playing a game, or if you have a particular trend of watching something at a particular period of time during the day or the weekend, you will find it's far more easy to continue it rather than to reverse it. So once a particular trend picks up, and when this trend, I speak about these trends from a human perspective, from you and me perspective, you can use the word habit. You can use the word our nature. Okay, it's a trend. You've been doing it for a certain amount of time that it's become like a repetitive thing. So it's become a habit. So it's far more easier to continue a habit, right? It's far more easier than to reverse it. Let's say it's a habit that most of us brush our teeth with our right hand. You pick the toothbrush on your right hand and you brush, right? Why don't you try tomorrow and brush with your left hand? Give it a shot, give it a try. You'll find it very difficult to just keep yourself remember that I have to brush with my left hand. Just not that easy. And so that's what tenet 6 tries to tell us. It's that don't judge the trend. The trend has a strength in itself and it will continue. It's easier for the trend to continue, and it will show you signals of reversal. Until and unless that signals come, do not predict. It's better for you to follow the trend rather than to predict the reversal. Now, this was just a basic theory, this Dow theory that we spoke about. There's more to it. There's far more to it. There's supports and resistance. There are classical patterns. We're going to talk about Japanese candlestick patterns also. So what we are going to do over a period of these sessions is every class, okay, I'm going to take up one. Like tomorrow, we're going to take up supports and resistance, and we're talking about classical patterns. Day 3, we're going to take up candlestick patterns. Day 4, we'll take up indicators. Day 5, we'll talk about trading strategies. Day 6, we'll talk about money management and traders psychology. Day 7, we're going to put all of these into a live market environment and show you how to get these things done. And I will make you also do these things practically. That's the idea. Any questions I have from Akhilesh? Is it essential that if one stock is in consolidation or sideways, then by comparing the volumes with past, can I say now it will go up in the volumes increased? Yes, to a lot of extent, Akhilesh, you will be able to say so. These are creating anticipations. Okay. If any technical queries during the reading the book, can I ask same to? Yes, you can ask the same. If you're asking during the period of our session till the last class, you can ask in the WhatsApp group. put @ and you can ask it. You can stay in touch with me even after the program gets over. You can connect me through various social media or WhatsApp. Are we talking about pivot points in the course too, Akhilesh? No, I'm not going to talk about pivot points here. See, we need to understand one thing, that this curriculum is is in line with the NCFM examinations, those who are going to give that. So I'm going to talk about most of the part of that book, NCFM, which will I cover. Plus, I'm going to add some more from my side, which will help you to trade better, right? And pivot points is something that I don't use, mainly because everyone uses it. You find so many people using the pivot points, and that is something that I will not be covering in this course, and something I don't cover in any of my programs, and I don't use it either. It's not needed, is what I feel, I believe. Okay, so we meet again tomorrow 1:30. Before that, I'm going to turn this into a PDF. I'm going to share it on your WhatsApp group. For the recording of the classes, you have to coordinate. You have to check with our coordinators. She will guide you the best. And when we meet again tomorrow, I'm going to take up supports and resistance and price patterns. Any stock selection or intraday trading for intraday, see, this will only happen once the program is over. Day one, you will not be able to do stock selection, right? Once the program is over, Shobham, you will be able to do this very easily. Can you mention which mode will be fine to clarify the doubts after this session, email or WhatsApp? Either will be fine, Atul. But that's after the program. Tab tak to main hoon, na, don't worry. All right. So with this, I'll end today's session. I think I've managed to stay on time. Yes, just a few seconds to go. And when we meet up tomorrow, 1:30, we'll take up supports and resistance and price patterns. Thank you. Enjoy the rest of your Saturday, and we'll meet again tomorrow afternoon. Thank you. Take care.